I think we may start. Boa tarde a todos. Good afternoon, everyone. Welcome to WHG Investment Book Club. This is a special edition. It's about how to research and analyze tech stocks with a legend of Wall Street, Mark Mahaney. For those who are new to the book club, we are approaching the 60th edition. So we are big believers that theory meets practice. And actually, tech represents a good chunk of our last 12 months outperformance, both on the long and the short side. So that's will be a interesting conversation. Mark is the writer of Nothing But Net, 10 times less stock picking lessons from Wall Street top tech analysts. He is the head of internet research team at Evercore ISI, has been covering the internet stocks for almost 25 years and has been 15 years ranked on Institutional II Investor of the Best Analyst. Mark, thank you very much for joining. This is the Brazilian investor community here. They're eager to understand and debate with you your knowledge regarding how to analyze tech stocks. Thank you very much.
Yeah, obrigado. Thank you, Daniel. Thank you for having me.
If you could tell a little bit about, I just spoke a little bit about your background, the intro, be interested to hear your stories, and what is the 10 lessons, what is the book about? And we have a lot of questions here to debate as well.
Okay, thank you, Daniel. So yeah, I'm the oldest and longest lasting internet analyst on Wall Street. So I started in '98 at Morgan Stanley. The first Friday I was in my office, I got a call from the CFO of a private company. It was an online auction company that was looking to go public. Its name was eBay. The CFO's name at the time was a guy named Gary Benger. I knew nothing about eBay, but I took my notes, on my laptop or my desktop, and then I went and tried the service. Now this is before mobile phones. This is when they just had a desktop service, and tried to buy something. I can't remember what I first bought on eBay, but and that was kind of the beginning for me. So I've been covering internet stocks. So that was eBay, Yahoo, AOL Time Warner, and then Amazon all along. Later on Google, later on Facebook, along the way Netflix, Uber, Pinterest, Snapchat. So a series of names like that. And I work with a group of there's a half dozen of us based here in San Francisco, and that's what we do. We look at public internet stocks. It's been a fascinating space to cover. If you were going to work on Wall Street for the last 25 years, I think the two most interesting sectors to work on would have been software and would have been, especially with the rise of cloud computing, and would have been consumer internet. Consumer internet has been a space of enormous wealth creation. It created its own portfolio, FANG, Facebook, Amazon, Netflix, Google. And I've been lucky enough to track that portfolio and to track the sector for a quarter of a century. So that's my background. I've worked at a couple of different firms along the way, but I've always done internet stocks. And I'm now here at Evercore ISI. And as part of this, I've been thinking about writing a book for several years, in part there's a little bit of memoir in the book. It was fun for me to go back and look at the changes that I lived through and experienced, in part because I felt like there were some good investing lessons for people when it comes to growth and tech stocks. Daniel, you'll probably remember this. There was this wonderful book called One Up on Wall Street by Peter Lynch, kind of an investment classic. I remember rereading that in the last year or two, and it's wonderful. But the stories and the stocks, they were written about in 1980 and 1990. The last time he did a version of the book was in 2000, where he talked about this emerging internet space and predicted that a good number of the internet stocks, high-flying internet stocks at the time, would crash and burn. He was right. But I think he also underappreciated just how much value creation would come from a handful of the names. And anyway, so I just thought there should be a book that would kind of give people a little bit of history but really draw lessons from these stocks and how well they've done that they can apply not to Facebook, Amazon, Netflix, and Google in the past, but to help them find the next Amazon or the next Facebook or the next Google. So that's what I tried to do. I tried to pull together 10 lessons in order to do that. I really enjoyed the process. Something I've been thinking about for years. It literally took 3 months just to focus just on writing it. And the book just recently came out. It was a labor of love, and really enjoyed it and glad I was able to finish it.
Interesting. How long did you take to finish the book?
Falei, nossa, reunião que eu agendo não é essa fumaça das PCB.
It just somebody, I think, is on mute here. Second. Okay, fine.
I literally took about 3 minutes to write, 3 months, 3 months to write it, about 3 months to edit it. Yeah, so it was about half a year. I'd been thinking about it for a couple of years. I gave a presentation based on that had most of the ideas in the book. I gave a public presentation on lessons from the internet sector. And then I took those, and I had 10 lessons, and I kind of developed that into a book. I think I changed 1 or 2 of the lessons. I added in a lot of details. I tried to draw examples that people would know. Uber and Grubhub, DoorDash, Booking, Expedia. So anyway, and then the rise and fall of Yahoo, the rise and fall of eBay. And I also tried to do, Daniel, I didn't want to just draw examples from some of the dramatic successes. I really wanted to try to get a sense of, why did Google do so well and Yahoo not? Why does DoorDash now trade at like 6 times the market cap at which the industry leader Grubhub was taken private at? And then I had I tried to draw from successes and losses, successes and victories in the public markets, but then also some of my own successes and losses, my hits and my misses. I had a buy on Blue Apron that turned out to be not a good call. And there's a few other examples in there. I probably stuck with a buy on Yahoo for too long. And at one point I wasn't bullish enough on Amazon. So anyway, and I've kind of applied these lessons. I had a buy on Netflix for a dozen years, and only recently, after the book was published earlier this year, I downgraded Netflix, really for one of the reasons I highlighted in the book, which is that tech stocks can be wonderful generators of wealth at reasonable valuations, but when growth stocks go X growth or X premium growth, it's usually very hard. Those stocks usually need a long time to season. I lived through that with Priceline.com/booking. And so when I saw what I thought was the negative inflection point with Netflix earlier this year, that was I felt like I understood the lesson, having written a book on it. So that led me to downgrade it. So that's, I've been practicing what I preach.
Interesting. And is there, from the 10 lessons, some lessons that you think are more important, or you think those 10 are, so if you wanna maybe elaborate on 3, 4 on those, will be interesting as well.
Well, I'll simplify it this way. If there's one thing to remember from the book, it's this concept, what I call DHQ. So it's dislocated high quality companies. By the way, we're living through an opportunity like that right now, given the tech market sell-off that we had earlier this year. And I think the strategy is, you identify what are the highest quality assets out there based on a series of factors, and I devote kind of a chapter to each one. Very good management teams, large total addressable markets or TAMs, compelling value propositions, and successful product innovation. You kind of look for those 4 things. There's a financial tell, which is the ability of a company to consistently generate 20% plus revenue growth. But you look for those kind of 4 qualitative factors to determine what's a really high quality asset. And then, Daniel, my advice is just wait. They all get dislocated. They all trade off from time to time. We just had a huge market sell-off earlier this year that allowed you to buy the highest quality assets like Google and Amazon at a discount to what their normal multiples are. And in the case of Facebook, for example, even at a discount to the market for what I think is a really high quality asset. So so that's my best, there's one piece of advice in the book, that there's a lot of things that lead up to it, but it's focus on DHQ, dislocated high quality, opportunities. And I think that's where you can generate really great returns in the market.
Interesting. You mentioned, I would say, one controversial name that a lot of Brazilian investors used to hold, or maybe some still are holding, which is Facebook. And one of you have like the four things that you mentioned to look, and one thing you mentioned is founder-led. So Facebook is still founder-led, but the market is questioning somewhat their capital allocation. At the same time, their core may be on a deceleration trend. How do you fear that, or do you think, Zuckerberg executed well the past kind of crisis, and he may be able to do so? I think today they came up something related to the pricing on metaverse stuff. So try to get a sense of a little bit on your call of Facebook that you debate on the book as well.
Yeah, and let me do this. This is when I talk about the screen in the book, this is the book. When I talk about the screens that I use, like the 4 factors in there to determine high quality assets. So I do have a preference for founder-led companies. And of all the big tech companies, I may be making a mistake, but I think just about the only major tech company, maybe Salesforce.com, but the only other one that I think is still founder-led is Facebook. And, I think Zuckerberg, obviously had great industry vision. His vision on social media was pretty impressive, pretty spot on. And I don't know whether the metaverse will become real or not. I'm sorry, it is already real, but whether it'll become widely adopted, I don't know. But he's had great vision, and he's thoroughly committed to the company. So anyway, that's kind of a positive check in my book. Total addressable market. That's another thing I really focus on. Find companies that are addressing very large TAMs. And Facebook is addressing the same TAM that Google is. It's the $1 trillion global advertising market. So it's a large end market. Third, the value proposition. I mean, sometimes we just forget this, but Facebook has a truly compelling value proposition, in part because it's free to users. But there's a reason why 3.5 billion people around the world use Facebook or Instagram, because it's a way to connect with people, it's a way to share with people, it's a great entertainment medium. So the value proposition to users is extremely high, but I also think the value proposition to advertisers has historically been very high as well. That's why they have 10 million advertisers on the site. And then the last screen that I look at is successful product innovation. They've had some pretty major acquisitions along the way. Instagram was a major successful, good product acquisition that they made. I think that they've introduced a lot of nice improvements to the actual user interface over time. They've also introduced things like Facebook Marketplace, Facebook Watch. So I think they generally score pretty well on product innovation. Like some companies, I think Amazon's probably a better product innovator. Google probably is too, but Facebook does a decent job of it. So I think about that. Like, to me, it's high quality. If the stock is trading off, 36% year to date. So it's lost 1/3 of its value. And from when it peaked last year, it's probably lost more like 40% of its value. And it's now trading at a discount to the S&P 500. For a business that can still do 30% operating margins, generate 20 to 30 billion in free cash flow, is probably going to recover to close to 20% revenue growth as they get beyond the COVID comps later this year. And they're buying back a lot of stock. That's a high quality asset. So it's dislocated. It's a high quality asset. To me, this is when you buy it. And then I'll also just make the point. I think there are 4 specific overhangs on the stock now. Are they going to get beaten by TikTok? Can they monetize their short form video called Reels? Can they overcome some of the ESG concerns, environmental, social, governance issues? And sort of feel like I'm missing one, but oh, and then can they overcome the Apple privacy changes? And I think there's a reasonable chance that they can address all those issues within a 6 to 12-month period. Those are the overhangs. If they can address them, you've got an opportunity here to make money on the stock on the long side, both because the stock, I think, will re-rate, and because I think you'll have upwards estimates revisions. Like I sometimes refer to that as a double-barreled, stock opportunity. I mean, you make money either because the stock goes higher as the earnings grow, or you make money as just the earnings hold, but the multiple goes higher, or you make money when both of them occur. And that's when you get the most upside in a stock, when a stock can re-rate and estimates can go up. And I think that's where you are on Facebook. Maybe not in the next 1, 2, or 3 months, but I think in the next year, I think that's what's going to happen. So I particularly like Facebook here for long-term investors.
Interesting. And I think it was lesson number 2 that you made as there will be blood even if you pick the best stocks. Now we are facing a period of like interest rates increase. Actually, in the 2000, you have this 2004, 2007 period as well. How do you see those stocks like behaving? Do you think they are kind of fairly valued for that? You said Facebook is a dislocated high quality, but in a sense of your broad coverage, do you think it's time to buy and jump in the tech better names, or no? As a sector, you're a little more concerned.
I'm not sure. Secondly, it depends on your time horizon. I've been pretty cautious and muted since the beginning of the year. We're living through extraordinary times. I've never invested in a market where we've had 8% inflation and a European land war, and very, very few people in the markets have had experience in markets like this. So I think it requires an enormous amount of humility. I wouldn't be surprised to see the markets correct more. I know we're up today, but I wouldn't be surprised to see the markets correct more, just because these times are so unusual. Our firm thinks that there's a 75% chance that Europe goes into a recession because of all the pressures related to the Russian invasion of the Ukraine. If COVID comes back, I mean, you could get worse supply chain challenges coming out of Asia. So I can come up with a pretty negative scenario. I don't think we are priced in a full-blown global recession in the back half of the year. And I think there's a distinct possibility that happens. I don't know what the odds are, 10, 15%, but it's not 0 and it's not 5%. There's a significant chance here. So I do worry about that. I do worry about, I think that rising rate environment and this unusually uncertain macro environment make it very hard for what I call price to sales stocks, or PS stocks that trade, they're high multiple and future profit growth stocks. Those do not do well in this environment. And I don't think that's going to change for a couple more months. I'm hoping that we have that inflation starts to come down a little bit, that we just had the peak inflation month. I think that's the headline today that's causing stocks to rise. But I think people said that, January and February were the peak inflation months, and that turned out not to be true. So I hope that March was the peak inflation month, in which case that does make it easier. I still think you probably need another Fed meeting. And then when you get the certainty over what the path of interest rate rises is like, and that inflation is likely to start trimming down, I think then you can step in and buy those price to sales stocks, those high multiple future profit growth stocks. Until then, I think you want to be very defensive. And, in tech, there's not really defensive names in tech. But then I stick with my highest quality names. Google and Amazon would be the highest quality names. And then I'd also throw in Booking and Expedia, just because I think they're high quality names, but they also have this wonderful recovery play, because it's very clear that travel is coming back very strongly this summer. We even heard that from believe it was Delta Airlines that reported last night or this morning.
Interesting. And you touched the price to sales. So, and one of the lessons of the book, I think it was number 4, was like revenues matter more than anything.
Yes.
Does the accounting today doesn't capture that you need to look in the revenue side, or do you separate that? Do you think free cash flow yield is important? How do you see when you go in terms of the financial metrics to value the company?
Well, I'm sorry. We should always be doing DCFs, discounted cash flow models on our names. We just use shortcuts. So whether that's price to sales multiples, EV to EBITDA, enterprise value to free cash flow, price to earnings, GAAP earnings, those are all shortcuts. You know, you look at, when I think about valuation, I like to know what the multiple is versus the company's or the stock's historic multiples. Like, is it lower or higher than its average forward multiple over the last couple of years? And then why? And how does that how do those multiples compare what's in the market or with the most directly comparable competitive set? So those are kind of the 2 or 3 things that we do. The reason that people use price to sales multiples, though, Daniel, is they do it for future growth. Future profit stocks. So if companies aren't profitable now, you got to put a multiple on something, and you can't put it on earnings. That means you probably can't put it on free cash flow. So you look at that price to sales. You see a lot of software or SaaS names trade that way now, and they'll carry these high price to sales multiples because generally they have very high gross margins, 70, 80% plus gross margins. And if they're good companies, they should have premium revenue growth. To me, that's greater than 20% revenue growth. And that's where you get those high single digit price to sales multiples, 6, 7, 8, 9 times. And then if it's more like 30 to 40% top line growth, then you get to that 10, 11, 12, 13 times price to sales multiples. So yeah, and the accounting, I mean, I'm assuming that when companies talk about their revenue, that I can sort of take them at their word, and hopefully it's audited, that kind of stuff. Hopefully that answered your question, Daniel.
And I listened to you in another like investment podcast, and one thing that you touched was that scales solves all. I think you used that expression. The way that you look for this price to sales, how do you increase the probability of making a successful investment on that? You look for other business models that are already like successful and they can replicate that. Just trying to send, because some names I would say are easier to do that, but some are like not proven yet. So how do you assess those higher growth, newer business on that matter?
Yeah, it's a good point. So what led me to the expression of scale solves everything. I think it was Eric Schmidt, one of the first CEOs, the public company CEO for Google for 10 years, for a decade. I think his statement was revenue solves everything. So it's sort of the same thing, but I just prefer the term scale. And so it gets to this question. When you look at companies that aren't profitable, because we're talking about how to value names and whether you should invest in names that are not profitable. Yes, I think you can. They're more risky, but you need to ask yourself a couple of questions. So I laid out these 4 questions in one of the chapters in the book. What do you do? I mean, there was the chapter on valuation. And what do you do when a company isn't profitable? I think you need to leave aside math and ask yourself 4 logic questions, which is that 1, are there any parts of the business that actually are already profitable? They're showing the ability to generate profits in maybe their oldest market or in one part of the business that'll give you confidence that the whole business can be profitable. Secondly, you look at are there public companies that have similar models that are already profitable. Snapchat, Twitter, and Pinterest all went public and had really robust market caps. They weren't profitable, but investors said, well, I've seen this before. I saw Facebook. And Facebook is a social media model that has 80% gross margins and is highly profitable at scale. I mean, highly profitable. And so the investor take on Pinterest, Snap, and Twitter was, well, I've seen this model before. User-generated content models can be highly profitable. It's okay that they're not profitable now because I've seen their model scale to profitability. I'm buying Snap, I'm buying Twitter, I'm buying Pinterest. That's the second question. The third question you have to ask yourself is, are there any particular reasons why scale, if the revenue goes up 2x, 4x, 8x, 10x, is there any reason why that wouldn't lead to profitability? Because in any business model, there are always some costs that are somewhat fixed. G&A, general and administrative costs, are usually reasonably fixed. The physical plants, can be relatively fixed, or they're step fixed costs. So the more volume you get against them, the more leverage there is against. I know some costs are variable, but a good number. There's always that continuum of costs being somewhat fixed to somewhat variable. And so the more, is there any reason why there are some cases, like if you can't sell dollar bills for 99 cents, that's that business model doesn't work. But I don't think I've ever seen that. So anyway, but there could be different situations. There could be models where they're just not going to get scale. They can get scale, but the business model is still inherently unprofitable. So my bias is, if you think the revenue base can really grow 2x, 4x, 10x, the chances are there's profits at the end of that. And then the last question I asked, and I came up with this a lot with Uber. So for the first 2.5 years after Uber went public, it was not profitable. It went public with the greatest losses of any company that ever filed to go public. I think they lost $7 billion. Now, there was some markdown of assets in there, so that wasn't really an economic cost, but still there was, or it wasn't a financial $7 billion, but it was an economic $7 billion. So they went public with massive losses, and then COVID came along and just crushed their business, their ride-sharing business. We just weren't using ride-sharing. But this company was able to reach profitability because the management team was able to take a lot of costs out. They sold a good number of their assets in international markets. They slimmed down their footprint. They laid off employees. They had to do it. But all of those steps, that management took got them faster towards profitability. And then they ended up reaching profitability with like a third lower volume than they had prior to the COVID pandemic. So to me, I found it interesting. Like, this is a company that really was able to take a lot of steps to just cut out costs. So you always want to ask yourselves kind of those 4 questions. And if you feel like you get decent chance at a yes for 2 or 3 of those questions, then I think you should be less focused on valuation. Like the valuation can take care of itself. And again, the 4 questions are there parts of the business that are already profitable? Are there competitors or comps in the market that are proving that this particular model works? Is there any particular reason why scale wouldn't lead the business to generate profits? And finally, are there specific steps, cost-cutting steps, sale of assets that the management can take to drive the business towards profitability? If you can get decent answers to those, that means you probably do have a company that's going to go from losing money to making money. And oftentimes those can be great inflection points in stocks.
Interesting. Want to make links what you wrote throughout the book. One thing, like I think lesson number 6, you said, is that the bigger the better, the total addressable market. That's one thing.
Yes.
The other thing that you said is like pull a Google, I think something like that. That
yes.
Companies that can grow like 20% per year for many years. My question is, because sometimes you see these huge numbers and you see sometimes a tiny company. Then what's the ideal? It's like a company that has like I would say mid-single digit market share, so they prove that they can grow, that you have some tests, but they still have like a big opportunity. Just try to sense how to get these 20% companies and how to assess the total addressable market. So 2 questions in one in that.
So let me try a couple of points here. One is that, I do look for companies that can generate consistent 20% revenue growth and can do it from scale, not from 10 million in revenue, but from a couple of 100 millions in revenue or for a couple of billion in revenue. 20% revenue growth is rare. If you look at the S&P 500, we studied this going back 5, 10, 20 years, it's a small single-digit percentage of the S&P 500 that can consistently grow 20%. 20% is not easy. 20% is 4 or 5 times faster than GDP growth, globally. 20% is not easy. You have to have very good execution, really good products, customer service, et cetera, et cetera. So companies that can do that and do it consistently, there's probably something special about that company. For based on those 4 things that I look at, either the TAM is really big or management team is exceptionally good, and these kind of things come together. The value proposition is very good, or there's very good product innovation. So to me, it's almost like a tell, like it's a clue, that 20% revenue growth. And when companies can do that and can sustain it for a couple of years, chances are they can do it for a few more years. It's, I know in investments, we always say that past performance is no good indicator of future performance. But when it comes to fundamentals, I think it's a very good indicator of future performance. Like you could have waited and bought Priceline or Amazon or Netflix 3 or 4 years after they started doing 20% revenue growth, and you could have stayed with that stock. So I do look for that. And then when it comes to total addressable markets, the ideal scenario is you find a company that faces a really large total addressable market and has a tiny share of that. That means that they can grow at premium growth rates and not reach maturation or saturation. So yeah, you need to do some thoughtful work about how big the TAM is. And I put some jokes in the book about it, like it's come to a point where every time I meet a new company, like the TAMs are always huge, like you have to be a little skeptical about the TAMs that they offer, because management teams now know that investors like me, growth investors, tech investors, are focused on big TAMs, total addressable markets, and so they'll talk up how big their TAMs are. And you want to be a little skeptical sometimes about how big of an opportunity the company really is facing.
And you mentioned, I think the example of Amazon, that they started in the 90s. Then you could have waited until I think 2006, 2007, yes, when you turn more like positive on what they accomplished and on their future. What was this turning point that you make? Because it's a company that had like almost a decade, so it was not a startup anymore, and you still had like a big runway in front. And as you touched at the beginning, looks like you still like the name as a current environment.
No, I do like the name now. And yeah, and there's also the question about, can you really extrapolate from the case of Amazon, because it's been a phenomenal stock. I forget now. I think the last time I ran these numbers, oh no, I have it here. Amazon, since its IPO, is up 166,000%. So if you had bought, if you had put in $100 at the time of its IPO, I mean, you and I would be watching this, sitting from the beach somewhere at our palatial estate, but of course it would have been irrational, I mean, to have held Amazon throughout that whole time. The question I asked myself in the book, and you just raised, is, well, when did it become rational? Like when should a growth investor, tech investor have said, I've just got to own Amazon. Like I need to own this thing. It's no longer speculative. It's a good growth asset. It's a good tech asset. And I think that happened. And I know there was already some of the stock had moved before then, but I think it really happened in kind of 2006, 2007, when the company went from being an online retailer of purely books and then expanded into multiple different categories, media, like CDs and videos, and then in consumer electronics, and then into fashion and household products. So they became a broad retailer. That happened over the first kind of 10 years of the company's existence. But then they started rolling out devices like these Amazon Kindles. It's not a huge product, but it showed the ability of a retailer to manufacture a product, an e-reader product. That's an interesting pivot or an extension. And then they rolled out Amazon Web Services, and that was in about 2005, 2006. And again, this was an online retailer of books, that's expanded to all retail, that's now selling devices and pretty successfully, and is now the leader in cloud computing. Like, when you see that, like, it's rare you see a company succeed in multiple different verticals. It's like, you should just, that was when it became a buy and hold stock in my book. You know, you wanted to buy it, especially when it got dislocated. And it became dislocated, you know, once every year or something like that. But, you know, that was a buy and hold stock because they showed the ability. It was like a mixture of these things. It's like, I know they face large TAMs. Retail is trillions in dollars in size. Cloud computing, we didn't know it at the time, but also turned out to be $1 trillion plus market. So they face large TAMs. They showed excellent product innovation. I mean, truly outstanding product innovation in very different verticals. Wow, you want a management team that can succeed in retail and in cloud computing? Like, those are very different competencies, and that they could do that was really impressive. So you had a very good tell on product innovation, and the management team was, you know, management team at the end is probably the most important of all these things to focus on. But, you know, you had a fully committed, you know, CEO, founder CEO, and you had a management team that was very consistent around the CEO, very little change. So all of that kind of came together, and I don't know if there was one exact moment in there, but somewhere in that 2006, 2007, 2008 period, you know, that Amazon became, in my book, you know, a buy and hold tech growth asset. That's what you look for.
No, thank you. And the one debate we have here is that in terms of the valuation, if it's worth or not, like, doing sum of the parts valuation. Do you think Amazon is a stock that you could do that? How do you? I know that you, in the beginning, we should all do DCF to understand, but sometimes DCF you have, like, as you point in the book, like 70 variables compounded in the long
Yes.
term. So you in there, you got on the other side. So just trying to sanity check the DCF. Do you think some of the parts is a metric to do or not?
Sure. Yes, absolutely. And we did a report on Amazon about 2 weeks ago when we did the sum of the parts, and essentially reached the conclusion that you can pay a fair market multiple, a fair comps multiple for their AWS business and for their advertising business, and get the retail business for essentially free. Like, that was like doing a sum of the parts gave us that insight. Absolutely, you can do some of the parts. Now, oftentimes people will do some of the parts because they believe that part of the business is going to get spun off. I don't think that's going to be the case with Amazon. I don't think they have any interest in spinning off AWS unless they were forced to by regulators. I don't think that's going to happen, and I don't think they have any interest in spinning it off. But yes, you can do absolutely. Like, I just sort of feel like if you find an asset that you think is really good, you know, try valuing it a couple of different ways. And again, look at the multiple that it's like today's multiple. Where does that rank? How does that, like, I think this is easier to do for investors. How does today's multiple rank with the multiple that the stock has traded in the past? You can get that kind of stuff sometimes off Google Finance, maybe even Yahoo Finance. There are other websites, you know, CNBC. There are sites that can help you find historical multiples, and then look at what their valuation is like versus the market and versus their most direct comps. And those are the things I like to. I think that's, yeah, and some of the parts could be another approach to it. That gets a little tricky because then you're thinking about intrinsic value for each of the businesses, but you can do that too.
And in the book, you discuss valuation, and you have some kind of metric, if I understand correctly, is kind of a PEG ratio wise. Could you elaborate a little bit? And you discussed the example of the Priceline.com that was surpassing the growth, and you were not paying for the growth. How do your multiple to say, oh, I'm comfortable with that?
Yeah. So I talk about a PEG ratio, and that's a price to earnings to growth ratio. So typically, not always, but typically stocks trade at a PE that's in line with or a turn above, at most a turn above what their growth rate is. The S&P 500, is expected to have roughly 10% earnings growth, and it trades at 17, 18, 19, 20 times earnings. So 1.5 to 2 times the growth. So that's the PE, the growth multiple. Or in that case, it would, if the market was trading at 20 times, and the earnings growth rate for the next year was 10%, well, that's a peg of 2. 20% divided by 10%, 2. And what I find interesting is there are times when stocks trade at a peg less than 1, where their PE multiple is lower than their expected growth rate, their earnings growth rate. Often, unless we have a real disaster with the company, where the company's going out of business, oftentimes that can be if you see that with the first I'm sorry, I just want to be careful here. I always focus on fundamentals first. Like, I want to find the high quality assets. Do that first. Spend 80% of your time trying to find the high quality assets, then look at the valuation. I think that's, if you look at the valuation first, then that means you're going to be, a lot of markets have a lot of stocks have low multiples because they're not good assets. And I think you're going to do better. I think, as a growth investor, tech investor, I think you have a better portfolio if you own high quality assets. You just try to get the right valuation on them, wait till they're dislocated, wait till they trade off, rather than buying cheap companies, cheap stocks, and hoping that the fundamentals improve, or that there's an M&A play, or that new management comes in and dramatically improves a company. So I prefer to buy the high quality assets and then try to get the valuation right, rather than get the valuation right and then hope that the fundamentals come through. I think focusing on the fundamentals first, focusing on the company, the high quality asset first, I think that's a better way to make money.
Thank you. Since we are approaching the end of time, let's open for questions from the audience. I just received 2 questions here. And one question is on, since you mentioned travel stocks, how do you feel about the current dynamic where short fundamentals are great, but you have the risk of slowdown or recession lingering as a backdrop? How do you approach this situation?
Well, that's a good question. And, if I'm wrong on Booking and Expedia, which I could well be, it's going to be because we may have a really good, strong summer travel season, but then the global recession is just going to, but then there could be a global recession, and that is going to impact travel. I just think that there's so much pent up travel demand now. I say that based on what some of these companies have said publicly. I say that based on Delta Airlines reporting this morning. And I think we're going to hear this when other airlines report, regional airlines, global airlines. I think they're going to report that, the people are coming back. Business travel is coming back. That's probably the last leg, but leisure travel is coming back aggressively. And and maybe that reverses because of a global recession. But I think that's what you would need, in order for travel really not to have what should be a very strong summer travel season. Hopefully that helps. I also feel like, the travel is consumer discretionary for the most part, but not completely as much as kind of all-out entertainment spend. I'd consider that more discretionary than travel.
Oh, and I received another question here from our analyst that sits in New York, Guilherme Novelo, that covers the tech growth stocks. On Facebook, what's the risk in your view that management continues to increase spending in 2023, even in case of further top-line deceleration? It will be that situation where they are growing less but spending more, compressing margins and cash flows.
Well, I may give you a surprising answer. I oftentimes find that companies, I generally want to look for high quality assets that are investing aggressively. I lived through the case of Yahoo and eBay, companies that didn't invest aggressively, that reported very strong operating margins. Grubhub is another example, and they missed their opportunities, and their growths today are much less than, growth outlooks are much weaker today than they could have been if they had invested aggressively, correctly, and with a little bit of luck into the right verticals, into the right areas. So, I don't want to say this the wrong way. The day that Amazon allows its margins to jump up to 20% is the day I'm going to worry, because if Amazon's allowing its margins, or or Facebook allows its margins to jump to 50%, my reaction would be, really? You don't have anything you could invest in, for future growth? You looked at all of your portfolio of growth options and you couldn't find something compelling, and therefore you're taking up your margins aggressively. So I think it's way too early for Facebook to be doing that. When the companies become mature, yes, but I just think there's too many things that Facebook needs to invest in for that to happen anytime soon. Hopefully that answered the question.
Thank you. Just a reminder, if you want to ask a question, please raise your hands or use the chat here. And just grabbing your view, you mentioned your top picks are your favorite names, if I got it right, are like Amazon and Google, but you also like Facebook. Is it right to say this is your favorite basket? Are there any not FANG stocks that you like as well?
Yeah, and Daniel, let's wrap up with this one. So again, it depends on your investment horizon. The shorter your investment horizon, the more you in this market, the more you want to be focused on high quality assets, but particularly ones that have kind of a recovery play. And so in that scenario, my top picks would be Amazon, Booking Holdings or Booking.com, and Google. If I'm willing to look out and willing to put up with a little bit of volatility, in the next 3 months as we go through summer, at least to the middle of summer, but I think I've got really great upside in 12 months out, then my list changes a little bit. And I'm going to bring in Facebook, I'm going to bring in Uber, I'm going to bring in Roku, and I'll bring in Spotify. So that's how I got kind of two different portfolios depending on whether you want to be near-term focused, kind of 2 to 3 months, or whether you can look out, 12 months and can handle some volatility in the near term.
Very good, Mark. Thank you very much. Hope to see you in person in Brazil. And
thank you.
Sign an autograph for the book as well.
Yeah, thank you. And I really enjoyed it. We went through a lot of the lessons that are in the book, so you don't need to buy the book. But if you did, I would appreciate it. And hopefully, if you find anything that's interesting in there, please email me. I've gotten a lot of emails of people with feedback and ideas and corrections and criticisms, and all of that's fair. I really enjoyed the process. Daniel, I enjoyed spending this last hour talking with you. Appreciated all your questions, and thanks for giving me the opportunity to talk about my ideas today.
Thank you very much.
Take care.
Have a good day. Bye.